Disclaimer: Bitcoin's current market dynamics have taken on a complexity that goes far beyond simple price narratives and superficial commentary. Bitcoin is not merely moving up and down in a random fashion. It is adjusting within a complex lattice of macro forces, on-chain behavior, whale psychology, and structural technical factors that most observers overlook. When we talk about Bitcoin and assign emotional labels like fear, greed, or panic, we are often telling a story that simplifies what is, in reality, a multi-layered interplay of capital flows and risk calculus. Understanding why Bitcoin behaves the way it does in any given period requires us to look beyond price alone and examine the forces that shape how and why large-scale holders position themselves. The term death signal has emerged in recent discourse because certain on-chain patterns seem, at face value, to indicate weakening conviction by entities that used to be confident in higher valuations. But calling something a death signal without exploring the deeper context conflates surface-level observation with underlying structural signals. Bitcoin's market is not driven by traders who merely react to headlines. It is driven by the behavior patterns of holders who have extremely high conviction thresholds and whose actions create ripples that smaller participants respond to over time. The distinction matters because it changes how we read every data point that comes out of on-chain analysis. When we inspect recent large-scale movements of Bitcoin from some of the largest known wallets, on-chain analysts have identified a non-trivial increase in outflows from exchange addresses to self-custody. But simply observing exchange outflows is not sufficient context, because these movements could merely be preparations for long-term holding or custodial rebalancing, rather than outright exits. What distinguishes the recent movements is the timing correlation between these outflows and the realization of losses by these same addresses. According to on-chain data aggregated from a variety of blockchain analytics platforms, a wallet that had been accumulating over multiple months began to reduce its balance, while simultaneously realizing losses relative to its average cost basis. This behavior is significant because it is counterintuitive if viewed only through the lens of long-term accumulation strategy. Instead of adding to its position during periods of stability, this wallet began trimming at prices lower than where it originally accrued holdings. The analytical interpretation here is that at least some holders who were previously operating with high conviction became cautious or decided to rebalance their exposure in response to changing conditions. Many market participants and commentators immediately equate this behavior with capitulation. Capitulation, as a concept, suggests a kind of surrender in the face of adverse conditions, where holders abruptly give up their positions under pressure. But real capitulation in Bitcoin markets historically shows itself through a rapid acceleration of sell pressure that overwhelms support at multiple levels simultaneously and forces prices into deep, structurally irrational zones. This is not what the current data shows. Instead, price behavior reflects structured support levels holding even as the volume of trading fluctuates and smaller participants react to surface-level volatility. The presence of large orders defending specific price ranges indicates that while some holders may be reducing risk exposure, others are actively managing where they want the market to stabilize, and doing so with precision. The behavior of large holders, commonly referred to as whales, must be understood through the lens of strategic repositioning rather than emotional instability. Whales are not monolithic actors. They represent capital pools with differentiated risk tolerances, time horizons, and portfolio objectives. When a whale moves coins out of an exchange into cold storage, it can signify confidence and reduced motivation to sell into short-term volatility. But when a whale moves coins out of cold storage into exchange wallets, this can suggest preparation for distribution or liquidity harvesting. However, the recent movements do not show a simple linear distribution pattern. Instead, what we see is a shift in how these holders segment their positions. They are peeling off tranches of Bitcoin at different price levels, which suggests they are managing exposure and liquidity rather than liquidating completely. This is a more sophisticated pattern of behavior that aligns with professional capital management rather than reactive decision-making under stress. The term death signal in this context is therefore misleading unless it is redefined to reflect a structural shift in holder behavior rather than a terminal breakdown of market conviction. The distinction between the two interpretations has meaningful consequences for how one positions in the current environment. A terminal breakdown implies that the structural foundation of the market has eroded. A structural shift in holder behavior implies a reallocation of capital within a functioning system that continues to operate with internal logic and coherent architecture. The primary reason Bitcoin's price has not collapsed despite these large holder movements is that there are reactive structural supports embedded within the market itself. On the technical side, Bitcoin's price operates in ranges that are defined by historically significant liquidity zones and clusters of orders from both institutions and algorithmic trading systems. When price approaches these zones, it typically experiences increased absorption of sell or buy pressure depending on the zone's orientation. These zones are not arbitrary. They are created over time by repeated positive and negative reactions at certain price levels, and the memory of these reactions is encoded into the behavior of participants who were present during their formation and who continue to reference them in current positioning. When we examine the recent price ranges, Bitcoin has demonstrated a compression phase where price is bounded by resistance above and support below. This compression is not random. It is a manifestation of two opposing forces operating simultaneously. First, there's the residual influence of holders who remain confident at or above current prices and are willing to provide liquidity that prevents deeper drawdowns. Second, there's the defensive positioning by short-term or quantitative traders who generate sell pressure near resistance to capture range movement and harvest liquidity from breakout attempts that ultimately fail. These two forces interact continuously, producing the oscillatory behavior that characterizes the current market phase. Additionally, there's a larger macro overlay which has dampened the amplitude of volatility relative to prior cycles. In previous market phases, macro conditions, such as heightened inflation or aggressive monetary policy tightening, exerted significant directional pressure on risk assets, including Bitcoin. The relationship between Bitcoin and traditional financial markets became tighter during periods of systemic stress, pulling Bitcoin in directions dictated by broader capital flows rather than internal market dynamics. But the recent trajectory of macroeconomic indicators has reduced the velocity of such shocks and transformed them into oscillations rather than sustained directional pushes. As a result, Bitcoin's internal market structure becomes the dominant influence on price behavior rather than exogenous macro events. This gives technical and on-chain signals more weight in determining short-term movements, but also introduces a dynamic where patterns can persist far longer than expected, because market participants are adapting to a new regime of volatility equilibrium that operates by different rules than what was observed in prior cycles. Understanding why the market is moving the way it currently is also requires examining the interaction between retail behavior and institutional positioning. Retail traders and investors often react to volatility with simplified emotional frameworks, which in turn can amplify moves as stop losses cluster and trigger cascades of automated exits. But institutional players and large holders tend to operate with frameworks that anticipate these reactions and incorporate them into their strategic outlook from the beginning. This means that while retail selling may create noise and amplify downward movement, technical structure can absorb such pressure without necessarily triggering the kind of liquidation feedback loops that historically produce much larger drawdowns. The institutional anticipation of retail behavior is not incidental. It is a feature of how sophisticated capital operates in Bitcoin markets, because the predictability of retail reactions creates exploitable liquidity conditions that larger players deliberately position around. The death signal narrative starts to unravel when we appreciate that the largest capital pools in Bitcoin do not abandon positions based on short-term fluctuations. Instead, they adjust over multiple phases and across multiple price ranges in a measured and deliberate manner. On-chain data shows that even as some large holders reduce exposure, they are not completely shedding Bitcoin. Instead, they are taking profits or reducing risk at multiple touchpoints across the distribution of their position. This layering behavior results in a market that appears to have distribution occurring, but is, in reality, realigning risk and liquidity across different participant segments rather than evacuating the asset class entirely. Another critical component of this phase is the presence of algorithmic and automated trading systems that have grown considerably in sophistication over the last few years. These systems provide bid and ask liquidity continuously and function to stabilize range trading across exchanges. They do not act on emotion, but on predefined logic and thresholds calibrated to respond to market conditions with consistency. When triggered, these systems can create rapid but structured price movements, which may superficially resemble panic or breakdowns, but are instead the result of computerized order execution reacting to liquidity conditions in a programmatic and predictable way. Understanding that a significant portion of observed market activity originates from these systems is essential for interpreting price behavior accurately. What looks like a panic sell may simply be an algorithm responding to a momentum threshold being breached and redistributing orders accordingly. Technical analysis of the current structure shows significant pivot levels where price repeatedly stalls or reverses direction. These pivot levels correspond with price ranges where Bitcoin has spent considerable time historically, indicating that institutional memory of these zones influences current behavior. Traders of all types recognize these ranges and act upon them, reinforcing their significance through repeated interaction. This makes the narrative of a single death signal overly simplistic, because it fails to account for the fact that price is effectively guided by historically reinforced zones of liquidity, absorption, and distribution. Larger holders take advantage of this by calibrating their movements within these regimes rather than outside them, using the structural memory of the market as a framework for execution rather than fighting against it. Another reason Bitcoin has not made an abrupt collapse is the underlying health of certain longer-term indicators, which suggest that fundamental on-chain demand, although not explosive, remains resilient. When we observe metrics, such as supply held by long-term holders, we see stagnation or gradual increase rather than mass distribution. Long-term holders, by definition, are not seeking to react to short-term volatility. Their continued retention of Bitcoin creates a buffer against sharp declines because it reduces the amount of circulating supply that could otherwise be sold during periods of distress. When recent movements showed a sizable holder trimming at a loss, this was only a fraction of the broader landscape of long-term positions. Many others remain unchanged, indicating that a singular exit event does not represent system-wide capitulation, regardless of how prominently it is highlighted in commentary. Moreover, the persistence of structural support is evidenced by how markets have absorbed sell pressure at key levels without triggering cascading liquidations that would push price into irrational downward spirals. In prior cycles, when momentum collapsed, markets experienced extended periods of range breakdown followed by panic selling as stop losses triggered en masse. This time, instead of that pattern, we see layered absorption where buyers step in at multiple tiers, creating what technical analysts refer to as a liquidity ladder. This ladder interrupts the flow of downward movement because liquidity pooled at each tier prevents price from breaking through without significant coordinated pressure. That coordinated pressure has not materialized, and its absence is itself a meaningful data point about the underlying health of the current market structure. In essence, the market is behaving in a way that suggests structural equilibrium, where absorbing sell pressure does not lead to immediate capitulation, nor does it translate into a runaway rally. Instead, price oscillates within boundaries created by the collective behavior of large holders, algorithmic systems, and established liquidity zones. This equilibrium is not static but dynamic and constantly evolving because it incorporates both short-term fluctuations and long-term trends simultaneously. Participants at every level contribute to this equilibrium in ways that are often invisible when viewed in isolation, but become coherent when examined as a system. Building on the understanding of market structure, well behavior, and technical overlay, it is essential to explore the hidden mechanics that drive short-term oscillations and the latent potential for directional movement. Bitcoin's price is influenced not only by the observable movements of large holders, but also by the underlying liquidity architecture that exists across exchanges, decentralized platforms, and private wallets. The market operates as a multi-tiered system where liquidity is distributed unevenly, and access to deep buy and sell orders can vary widely depending on the participant and the platform involved. This unevenness creates zones of differential pressure where small perturbations in capital flow can produce amplified movements when they interact with thin liquidity points. Conversely, thick liquidity areas absorb shocks and stabilize price, creating the appearance of a floor or resistance even when underlying sentiment is shifting beneath the surface. On-chain metrics reveal that while some wallets are reducing balances, the majority of coins remain dormant or locked into long-term holdings. This creates a structural buffer that absorbs volatility and prevents cascading liquidations that historically lead to rapid price collapses. The behavior of these dormant holders is critical because it demonstrates that the visible market participants are only a fraction of the total supply in existence. The latent supply, held by strategic investors, acts as a stabilizing force that moderates the observable price response to external events. When a large holder distributes and creates visible downward pressure, the dormant supply acts as a counterweight, because that supply is unavailable for sale and therefore cannot contribute to the cascade. This is one of the most structurally important but least discussed aspects of Bitcoin's market architecture. The sheer quantity of supply that is effectively removed from circulation by long-term holders with high conviction creates a fundamental asymmetry between observable sell pressure and the total supply that would theoretically be needed to overwhelm structural support. That asymmetry is a persistent feature of Bitcoin markets that grows more pronounced as the asset matures and a larger proportion of supply migrates into long-term hands. The interaction between algorithmic trading systems and human capital allocation decisions creates a feedback dynamic that is worth examining closely. Algorithms continuously monitor order book depth, executed trade flow, and price velocity. They execute trades that reinforce or absorb market pressure depending on preset thresholds calibrated to current conditions. This results in structured oscillations where price moves through compressed ranges without breaking structural support levels prematurely. The apparent indecision in price is therefore less an expression of market weakness and more a reflection of equilibrium maintained by the coordinated interplay between capital holders and automated systems working in parallel. each responding to the same underlying conditions from different angles. Technical indicators further clarify the market's behavior. Moving averages across multiple periods converge, creating a zone of potential inflection. Momentum indicators such as MACD and RSI suggest that energy is being accumulated rather than dissipated across the current compression phase. This accumulation of momentum occurs beneath the surface and manifests as micro-oscillations in price, which are absorbed by liquidity zones rather than triggering abrupt directional shifts. Historical patterns from prior cycles show that similar periods of compression preceded significant directional movements, but only after liquidity and risk had been sufficiently rebalanced across holders and participant segments. The process of rebalancing is not instantaneous. It unfolds across weeks and sometimes months, during which the surface appearance of indecision masks the deeper structural work being done. The zone frequently discussed in analysis as a key structural reference represents a convergence of multiple technical and on-chain factors. It coincides with historically significant cost basis levels for long-term holders, aggregated buy orders, and key liquidity clusters across exchanges. This convergence makes the zone probabilistically important as a potential equilibrium point rather than an absolute guarantee of support. Similarly, upper resistance areas are defined not only by prior price peaks, but by concentrations of sell orders that have been strategically placed to manage exposure. This layered distribution of liquidity creates a range within which the market can oscillate while maintaining overall structural stability. Neither the floor nor the ceiling is absolute. Both are probabilistic expressions of where capital is concentrated and where participant behavior reinforces structural levels. Observing whale behavior in this context shows that large holders do not act randomly. They are executing phased strategies that may include peeling off portions of positions, transferring assets to cold storage, or selectively selling into high liquidity points to minimize market impact. These actions are measured and take into account both technical zones and anticipated market reactions. By distributing movements over multiple stages, whales can manage risk without destabilizing the broader market. The probabilistic nature of these actions creates a landscape where short-term traders perceive volatility while the underlying structure remains resilient to the kind of damage that would produce a genuine breakdown. An important but often underappreciated dimension of whale behavior is the role of portfolio rebalancing rather than directional conviction. Large holders operating at the institutional level are subject to risk management frameworks that require periodic rebalancing of exposure across asset classes, regardless of their directional view on any single asset. When a large holder reduces Bitcoin exposure, it may not be making a bearish statement about the asset. It may simply be maintaining a target allocation within a broader portfolio that has experienced relative appreciation in Bitcoin versus other holdings. This rebalancing-driven behavior is often indistinguishable from conviction-driven selling when viewed solely through the lens of on-chain outflow data, which is precisely why the surface-level interpretation of whale exits as bearish signals is frequently incomplete. The analytical challenge lies in distinguishing between position reduction driven by allocation mechanics and position reduction driven by a change in fundamental conviction, and the data alone rarely provides a clear answer. Retail reactions, influenced by observable price movements and commentary, amplify oscillations, but rarely overturn the structural equilibrium because the majority of capital remains in stable, long-term positions that are not responsive to short-term narrative shifts. The interplay between retail behavior and large holder strategy creates observable patterns that can be misinterpreted as definitive signals without understanding the full context in which those patterns arise. A move that looks alarming to a participant focused on the 1-hour chart may be entirely unremarkable to a participant managing a position with a multi-year horizon. These different frames of reference coexist within the same market and generate activity that appears contradictory when examined without acknowledging the difference in time horizon. Macro influences also exert subtle but meaningful effects on market behavior. Global liquidity, interest rate expectations, and shifts in correlated risk assets introduce additional layers of pressure that interact with internal market mechanics in ways that are not always linear or predictable. Rather than dictating outcomes directly, these factors modulate the thresholds at which whales, institutions, and algorithms adjust their positions. This modulation contributes to the dynamic tension currently observed in price movements. It creates a situation where the same internal market structure can produce different outcomes depending on the macro environment that surrounds it, which is why understanding the current macro context matters, even when it is not the primary driver of day-to-day price behavior. It is essential to recognize that short-term exits or reductions in exposure by whales do not signify capitulation, but rather strategic repositioning within an evolving market ecosystem. This repositioning, when analyzed alongside long-term holder retention, liquidity absorption, and algorithmic stabilization, demonstrates that the market is recalibrating rather than collapsing. The concentration of retained supply by long-term holders, combined with distributed liquidity and structured algorithmic intervention, creates a scenario where price can maintain stability even amidst significant observed movement by large participants. The system is designed through the behavior of its participants to be more resilient than surface-level analysis would suggest. Another important dimension is the feedback mechanism created by the visibility of on-chain data itself. As analytics platforms provide insight into whale movements and liquidity distribution in near real time, participants at various levels respond preemptively or opportunistically to what they observe. This meta layer of observation amplifies the importance of behavioral signals while simultaneously creating stabilizing feedback loops, because large holders anticipate these reactions and calibrate their own activity accordingly. The result is a market in which observed movement is a reflection of multi-scale strategic interaction rather than simple cause and effect dynamics. When a large wallet moves coins and on-chain analysts publish their observations, the market response to that publication becomes part of the dynamic that influences subsequent behavior from the wallet itself. This reflexive quality of on-chain data visibility is a relatively recent development in Bitcoin markets, and its implications for structural stability are significant. In earlier cycles, information asymmetry between large holders and retail participants was considerably wider, meaning that large movements could unfold with far less anticipatory reaction from other participants. Today, the narrowing of that information asymmetry creates a more reflexive and self-aware market environment where strategic behavior at every level takes into account the visibility of that behavior to others. This reflexivity contributes to the measured and deliberate nature of the current market phase, because participants at all levels understand that their actions are being observed, and that the market's reaction to those actions will itself influence the outcome of the strategy being executed. The narrative of a death signal simplifies this complex adaptive system into a binary outcome, but fails to account for the nuanced orchestration of capital flows, liquidity layering, and behavioral anticipation that characterizes the current environment. Observed volatility is a byproduct of structural mechanics rather than an indicator of terminal breakdown. Technical ranges, historical cost basis levels, and algorithmic liquidity combine with long-term holder behavior to create a buffer that stabilizes price even as individual wallets reduce exposure. These combined forces demonstrate that the market operates on multiple temporal and strategic layers simultaneously, and that understanding any single layer in isolation produces an incomplete picture. Observers focusing solely on headline movements or short-term exits miss the larger context in which price is functioning. The tension between apparent pressure points and structural equilibrium creates oscillations that can appear precarious but are in fact consistent with historically observed consolidation phases. This consolidation phase is characterized by selective distribution, retention of latent supply, algorithmic reinforcement of liquidity zones, and the continuous absorption of volatility by participants whose time horizon insulates them from reacting to short-term pressure. As the market continues to process these forces, the mechanics of absorption and redistribution become more evident to those who examine the data without the overlay of simplified narratives. The final layer of understanding Bitcoin's current market behavior involves integrating all prior observations into a cohesive framework that explains both the latent tension and the potential for future directional movement. By synthesizing whale behavior, long-term holder retention, algorithmic stabilization, liquidity layering, technical ranges, and macro overlay, we can begin to see a pattern that explains why price has oscillated within defined zones rather than collapsing outright. The market's apparent fragility is offset by structural resilience, which emerges from the concentration of supply in long-term hands, phased distribution by large holders, and active absorption of volatility by algorithmic and institutional participants operating with distinct but complementary objectives. Each of these layers contributes to a probabilistic equilibrium, where price finds temporary stabilization at key support levels while remaining sensitive to directional catalysts that have not yet materialized in sufficient force. The concept of a death signal in this context is best reframed as an indicator of structural reallocation rather than imminent collapse. When large holders reduce exposure, they are not necessarily surrendering conviction, but adjusting positions within the constraints of liquidity zones, anticipated retail reactions, and algorithmic thresholds. This strategic adjustment creates observable oscillations without fundamentally undermining the market's equilibrium or eroding the structural foundation upon which the next directional phase will be built. The historically significant support zone, often cited in analysis, functions as a probabilistic floor where price may find temporary support but is not guaranteed to remain above it indefinitely. The significance of this zone is amplified by the layering of liquidity and the concentration of latent supply, which collectively absorb downward pressure and create resilience against abrupt declines. Conversely, upper resistance zones are defined by concentrated sell orders, placed by both large holders and institutional participants managing their exposure in a deliberate and phased manner. These zones act as ceilings that moderate upward movement until sufficient directional momentum accumulates to breach them. The interplay between these upper and lower structural boundaries creates a range within which price oscillates, reflecting the dynamic tension between capital allocation, risk management, and behavioral anticipation. Within this range, short-term price movements are shaped not solely by individual trades, but by the aggregated effect of strategic repositioning across multiple participants operating with different objectives. Large holders peel off positions incrementally, retail traders respond to what they observe, and algorithmic systems absorb and redistribute liquidity in response to order flow. The result is a layered, multi-scale feedback loop that governs observable price behavior and produces patterns that are structurally coherent even when they appear disorderly at the surface level. Historical patterns from previous cycles demonstrate that similar compression phases preceded extended directional moves once liquidity and risk were sufficiently realigned. The current phase is consistent with these observations, suggesting that the market is undergoing a recalibration that preserves structural stability while processing the conditions necessary for the next phase of price behavior. On-chain data supports this interpretation. By analyzing spent output profit ratio, long-term holder position change, exchange inflows and outflows, and wallet clustering patterns, we see that the majority of coins remain in strategic positions. This indicates that the market is not experiencing systemic liquidation, but rather a selective and phased redistribution of exposure across participant tiers. Large-scale exits are being absorbed within a broader framework of liquidity distribution, creating oscillations that are structurally coherent even when they appear tense from the perspective of participants with a shorter time horizon. The interaction between algorithmic systems and human capital further reinforces this equilibrium. Automated trading monitors, order books, liquidity clusters, and momentum thresholds to execute trades that stabilize ranges and prevent runaway movements in either direction. These systems operate without emotional input, yet they are sensitive to human behavior patterns, creating a hybrid dynamic in which observed volatility is a byproduct of multi-scale coordination rather than uncontrolled reaction. This hybrid system ensures that price can maintain stability despite individual large holder movements and retail reactions, because the mechanical layer of the market is specifically designed to respond to liquidity imbalances and restore equilibrium through algorithmic intervention. The apparent tension between observed pressure points and structural equilibrium is a natural consequence of the market's layered architecture. Rather than signaling imminent collapse, oscillations at this level reflect ongoing recalibration and risk redistribution across tiers of participants, each operating within their own framework and time horizon. Liquidity aggregation across exchanges, cold storage, and decentralized platforms creates differential absorption zones where pressure from mid-tier or retail selling is mitigated by latent supply held by long-term investors who have no motivation to respond to short-term price movements. The result is a market that is resilient, adaptive, and capable of maintaining oscillatory stability even in the face of significant capital flows from visible participants. Macro influences such as global liquidity conditions, interest rate expectations, and correlated risk asset movements modulate this internal equilibrium rather than dictating outcomes directly. Large holders and algorithmic systems adjust to these external pressures in a strategic and measured way, allowing the market to process macro signals without triggering systemic instability. The feedback loop created by the visibility of on-chain data and behavioral analytics further enhances this adaptive mechanism. Participants anticipate reactions to observed movements, creating a self-reinforcing cycle of strategic positioning that preserves structural equilibrium while distributing risk across participant layers in a continuous and dynamic process. While retail sentiment amplifies short-term fluctuations, the majority of supply remains under strategic control, buffering against cascading liquidations and preserving probabilistic support zones from the kind of rapid erosion that defined prior breakdown phases. The integration of whale behavior, long-term holder retention, algorithmic stabilization, liquidity layering, technical ranges, and macro overlay produces a market that is structurally sophisticated and demonstrably more resilient than earlier cycles. Observed price movements are not deterministic indicators of collapse or breakout, but emergent properties of complex adaptive interactions across multiple temporal and strategic scales. This understanding reframes narratives of death signals or last chance floors as probabilistic indicators of structural realignment rather than guarantees of specific directional outcomes. The current market demonstrates a multidimensional adaptive system where oscillations, compression, and layered liquidity coexist with latent directional potential that has not yet been released. Large holders strategically manage their exposure across multiple price levels. Long-term holders retain significant supply that functions as a stabilizing reservoir. Algorithmic systems continuously maintain the microstructure of liquidity, and macro influences modulate the thresholds at which participants across all tiers adjust their behavior. These combined forces create a market in which observed volatility is a manifestation of coordinated interactions across all levels of the participant hierarchy, rather than unmitigated risk or reactive panic. Key structural zones and historically significant price clusters serve as focal points within this adaptive system, representing probabilistic equilibrium zones shaped by layered liquidity and participant behavior that has been reinforced over multiple cycles. Rather than viewing these zones as immutable floors or ceilings, they are better understood as points of sensitivity where structural forces interact with probabilistic capital allocation to produce observable price behavior. The significance of any given zone is not intrinsic, but derived from the concentration of participant activity around it, which is itself a function of historical interaction, cost-basis distribution, and strategic positioning by capital that operates with long-term objectives. To further appreciate the depth of the current market phase, it is worth examining the concept of cost-basis distribution as a structural variable in its own right. When a significant portion of the supply in circulation is held at or near the current market price, this creates a zone of heightened sensitivity where even modest changes in price direction can produce outsized behavioral responses. Holders whose cost basis closely matches the current price are in a neutral position relative to profit and loss, and their behavior is shaped by forward expectations rather than locked-in gains or losses. This makes their decision-making particularly responsive to macro signals, on-chain observations, and shifts in the broader narrative. Understanding where this concentration exists across the supply distribution allows analysts to identify zones where behavioral pivots are more likely, and where reactive pressure could either accelerate or decelerate price movement. The role of derivatives markets also contributes meaningfully to the structural dynamics of the current phase. Open interest in Bitcoin futures and options reflects the aggregate positioning of participants who are expressing directional or hedging views using leverage. When open interest is elevated relative to spot market activity, the potential for liquidation cascades increases because leverage positions are forced to close when price moves against them beyond defined thresholds. The current configuration of derivatives market shows that while positioning exists in both directions, neither side has built up the kind of extreme imbalance that historically preceded the most violent liquidation events. This relative balance in derivatives positioning reinforces the structural equilibrium observed in the spot market and contributes to the measured oscillatory behavior that defines the current phase. The derivatives layer of the market is not operating in isolation. It interacts continuously with spot market activity, on-chain movements, and algorithmic execution to create a composite picture of positioning that is more balanced and more structurally stable than the surface-level price behavior might suggest to an observer without access to the full data landscape. Monitoring funding rates, open interest distribution, and options flow alongside spot and on-chain metrics provides a more complete picture of the forces shaping current price behavior. Furthermore, the role of mining economics introduces another layer of structural consideration that is often absent from price-focused analysis. Bitcoin miners are producers who must sell a portion of their output to cover operational costs, and their behavior creates a steady source of sell pressure that the market must absorb on a continuous basis. During periods when mining revenue is under pressure due to lower prices or elevated costs, miners may sell more aggressively, adding to observable sell pressure in the spot market. Conversely, when mining economics are favorable, miners may hold output and reduce the flow of new supply to exchanges. Monitoring miner behavior through on-chain metrics such as miner outflows and hash rate trajectory provides an additional dimension of structural analysis that informs the broader picture of supply and demand dynamics currently shaping price behavior. The integration of all these dimensions, cost-basis distribution, derivatives positioning, miner behavior, long-term holder retention, the whale repositioning, algorithmic stabilization, and macro modulation, produces a framework for understanding Bitcoin's current market phase that is far more robust than any single narrative can provide. Each dimension contributes information that the others cannot, and it is only by examining them together that a coherent picture of the market's structural condition emerges. This multidimensional approach does not produce certainty about future outcomes, but it does produce a well-grounded basis for assessing the relative probability of different scenarios and for understanding why the market behaves as it does at the present moment. In conclusion, the current phase of Bitcoin markets is characterized by compression, recalibration, and strategic positioning rather than collapse. Large holders adjust exposure incrementally, and with clear structural logic, long-term holders provide a stabilizing buffer by retaining supply that is unavailable to the market. Algorithmic systems absorb micro-level volatility without amplifying it into larger structural damage. Liquidity layers create structured absorption points at multiple price levels. Technical ranges guide trading activity for participants of all types, and macro factors modulate the thresholds at which adjustments are made. The interplay of these forces produces oscillatory behavior that is consistent with historical patterns of consolidation observed in prior cycles before directional movement resumed. It is also worth acknowledging that the current phase places a premium on analytical patience. In prior cycles, major directional moves often arrived with recognizable momentum signatures that were visible across multiple timeframes simultaneously. In the current environment, where algorithmic systems smooth out volatility and long-term holders buffer against abrupt dislocations, these momentum signatures develop more gradually and require more careful observation to detect. This means that the informational edge in the current market belongs not to those who react fastest, but to those who maintain the most comprehensive and structurally grounded view of the forces at work. The participants who interpret compression as weakness and oscillation as indecision are likely to be less well-positioned than those who understand both as the natural expression of a market processing large amounts of capital through layered structural mechanics. The market is not failing to make a decision. It is executing a process that is more complex and more deliberate than a simple binary outcome would require, and the evidence of that process is visible to those who look at it correctly. Observed whale exits, retail reactions, and price fluctuations should therefore be interpreted within this multi-scale adaptive framework rather than through the simplifying lens of emotional narrative. Rather than signaling imminent collapse, they reveal the nuanced orchestration of capital flows, structural equilibrium, and behavioral anticipation that defines the current phase of market development. The market's resilience, layered liquidity architecture, and adaptive participant dynamics indicate that price oscillations are emergent properties of a sophisticated and functioning system, rather than indicators of terminal structural breakdown. This framework provides a comprehensive basis for understanding current Bitcoin behavior, interpreting structural tension in its proper context, and developing a well-grounded perspective on potential future movements without resorting to simplistic narratives that collapse a complex, multi-scale adaptive market into a single signal or a single outcome.